Welcome back to the Wall Street Podcast.
Great to be here.
Today, we're doing a deep dive into the Wall Street Journal from September 16, 2025.
Yes, lots to unpack. We're looking at some key economic and financial shifts.
Exactly. Things like Federal Reserve independence, potential changes in corporate reporting, challenges with economic data.
And market reactions too, right? Policy impacts, innovation. It's quite a mix.
Let's jump right in with the Fed. Stephen Miran, a Trump administration economic advisor, was confirmed to the Fed board.
The timing is, well, notable. Just hours before rate decision meeting.
Raises immediate questions about independence, doesn't it?
It certainly fuels the debate. And then there's the parallel story with Governor Lisa Cook.
Right. The administration's request to remove her was rejected by a federal court. She denies the allegations, suggests political.
Especially with differing views on interest rates. And a cut widely expected. It highlights this tension around executive influence.
Okay, shifting gears slightly. Corporate reporting. President Trump's brought up the idea, again, moving from quarterly to semi-annual earnings reports.
He mentioned it in his first term, too. The argument is, cost savings, encouraging long-term focus.
And the long-term stock exchange is actually planning to petition the SEC on this.
But there's pushback, obviously. Investors rely heavily on that quarterly data for transparency.
So less frequent reporting. Could that mean less market efficiency?
Potentially.
Yeah.
It could increase information asymmetry, basically, not everyone having the same info at the same time. That worries some investors.
Another challenge we're seeing is with economic data itself. Survey participation rates are falling.
Yeah, this is a serious issue. It's affecting the accuracy of crucial government reports, like the jobs numbers from the Bureau of Labor Statistics.
Leading to bigger revisions more often, makes it harder to know what's really going on.
And the reasons, well, there's survey fatigue. People are just tired of calls, caller ID, screening them out.
Plus, remote work makes reaching businesses trickier, I suppose.
Exactly. So if the data is less reliable, it impacts forecasting and how effective policy responses can be. Creates uncertainty all around.
Let's talk tariffs. The 50% U.S. tariffs on Indian imports, we're seeing direct impacts.
Absolutely. Businesses like those in central New Jersey's Little India are feeling the squeeze. Garments, jewelry, groceries.
They have to either absorb the costs, which is tough, or raise prices significantly.
And it's not just imports. Other administration actions, like halting offshore wind farm construction, or Estid's projects, for example.
And proposing to phase out clean energy tax credits. That's causing real financial strain for renewable energy companies.
Big restructuring efforts underway there. It creates significant regulatory uncertainty, hindering investment.
And for the average person, well, expect shoe prices to keep climbing as those tariffs get passed on.
It's a direct hit to household budgets, unfortunately.
Now, looking at market reactions, gold hit a record high, over $3,680 an ounce.
Classic safe haven play. Investors are clearly nervous about U.S. economic uncertainty and these policy shifts.
But contrast that with London's office market. It's apparently booming.
Yes, fueled by American law and finance firms moving in, plus the growing tech presence. Shows strong demand for premium space there, despite other uncertainties.
So a bit of a split picture, risk aversion driving gold, but also confidence in certain real estate sectors.
And there's innovation, too. Companies like Comcast and Roku are developing AI tools for streaming TV ads.
Trying to make it more accessible for smaller businesses, right? Like the social media ad model.
Exactly. Self-service platforms, making it cheaper and easier to get targeted ads on streaming services.
Okay, let's dig a bit deeper into some of these. First, back to the Fed. What are the real ramifications, immediate and maybe long-term, of this increasing executive influence?
Well, the biggest immediate risk is the perception of political influence on monetary policy. If markets think the Fed isn't independent, it can shake investor confidence.
And damage credibility.
Absolutely. The Fed's credibility is crucial for managing inflation and employment effectively. Long-term, it could mean more policy uncertainty, potentially more volatility.
Okay, Module 2. What if we do shift to semi-annual earnings reports? How does that change things for markets, companies, investors?
The main impact would likely be reduced market transparency. Investors get less frequent updates. That information asymmetry we mentioned, it could worsen.
Could that make markets choppier?
It might increase volatility, yes. Or maybe it pushes more capital towards private markets where disclosure is already less frequent, potentially making public markets less attractive for some. Companies might focus more long-term, but investors lose that regular insight.
And Module 3, the degrading economic data. What are the tangible risks from falling survey participation?
The risks are pretty direct. If key indicators like job growth numbers are less accurate, policymakers might misjudge the economy's health.
Leading to flawed policy decisions.
Precisely. Inappropriate interest rate moves, maybe, or mistimed fiscal responses. For investors, it just clouds the picture. More uncertainty makes allocating capital efficiently much harder. You risk making decisions based on, well, faulty signals.
So, connecting this back to daily life, you're likely feeling the tariff impact already, or soon will, with higher prices on goods like shoes or specific foods.
Definitely a direct consumer impact there.
And that AI and streaming ads, that points to a future where advertising gets even more targeted, maybe more pervasive. It changes how businesses reach you and how you experience media.
A very different landscape shaping up.
Which leads us to our final thought. As these established norms, Fed independence, reporting frequency, data reliability, face pressure from politics and practical challenges, how does the investment world adapt?
That's the key question.
When traditional signals become blurred, what new strategies are needed to assess risk and find opportunity? Something for all of us to consider.